So we are modeling for portfolio management. Okay. You are given two stocks, A and B, for 12 years. Now, whenever we are dealing with any kind of analytics, we should always work on returns and not prices, because simply prices is not a scalable measure. Returns is a much more scalable measure, isn't it? It enhances comparability if it is scaled down to a percentage. Otherwise, different volumes could mean very different results if you just compare the prices. है ना? So we first find out the returns for stock A and stock B, which is nothing but next month return minus previous month return divided by previous month return. So you get these returns for stock A and stock B. Now, how do you get the average return? You can simply find out the mean returns by taking the average. So it is 6.64% for A and 4.02% for B. Okay? And for standard deviation, we can use the STDEV function is equal to STDEV dot S, and you can take the returns of A, comma, return. Remember, all your analytics has to be on the return. Yeah, everything on returns. So you get 33.01% for A and 8.59% for B. Right? Yes or no? Now, next step, are we ready to compute portfolio return? The answer is yes. We are ready to compute portfolio return. How? Because portfolio return के लिए मुझे सिर्फ और सिर्फ क्या चाहिए? I just need the weights and the returns. So that is there already with us. I told you we can assume a weight of 25% for A and 75% for B. But so let's compute the portfolio returns. So if I capture the portfolio return here, it comes to what? Some other, we should first capture the portfolio. So portfolio consists of two securities, A and B. Weight of A is 0.25, weight of B is 1 minus 0.25. And remember, the sum of the weights for a portfolio should always be equal to 1. Next is now to capture your returns. Which is 6.64% for A and 4.02% for B. And then risks, which is 33.01% for A and 8.59% for B. Now, if I have to capture the portfolio return, I will simply take the sum product. Sum product means summation of the products. I told you we have to take weighted average. So we have to essentially do weight of A into return of A plus weight of B into return of B, which is nothing but summation of products of weights and returns. So I can do sum product of my weights, comma, returns, bracket close. I will get the portfolio return as 4.68%. For portfolio risk, we do square root of the variance. Variance is what? WA square into sigma A square plus WB square into sigma B square plus twice weight of A, weight of B, sigma A, sigma B into R. Now we don't know R. Do we know R? No. So I'll capture my R here. R is the correlation. How do you get the correlation? You can use the correl function. Correlation between the returns of stock A and stock B. The correlation is negative. Can you see it's minus 0.149? So minus would mean that if A goes up along with the market, B will actually go down and vice versa, which will be good for your portfolio because it will actually end up reducing your risk. And portfolio risk comes out to be 9.68%. Now, what we did just now is actually your base case. So I've just taken a base case. I've still not done, neither have I attempted to minimize the risk, nor have I attempted to optimize the portfolio. I've just done the return risk metrics for the current situation. 25% of my money invested in A, 75% of my money invested in B. तो अब सपोज मेरे को रिस्क को मिनिमाइज करना है. Please pay attention. I will just create now. Always better to create separate tables. I am going to create a separate one and call it risk minimization or portfolio risk minimization rather. That's a better term. Portfolio risk minimization. Okay. And you can capture your returns and risks in correlation from the above table. Do not copy paste, please. Otherwise, you will get wrong results. It has to be linkage based. Now, to minimize the risk, we can use the solver functionality in Excel. Solver. Okay. So if you go to data, you will see on the right hand side, remember when we added those add-ins, I asked you to add the solver also. So ये आपका solver है. Now, what is it asking you? Set objective. What is my objective now? My objective is to minimize the. So set objective may I will link it to my risk cell. Where is my risk cell? You should be able to identify where your risk cell is. So I will just link it to this cell which has the risk. Okay? And set it to minimum value. Why? Because my objective is to minimize the risk. And what am I asking Excel to do? For me as a portfolio manager or me as an investment advisor, what am I asking Excel to do? I am asking Excel to perform random iterations and keep on rebalancing the portfolio till my objective of risk minimization is achieved. आप समझ रहे हो? It will try different permutations and combinations of A and B till it actually arrives at the lowest possible. So I will set my objective, which is risk to minimum, by changing what? By changing my weights. That is what is called as rebalancing your portfolio. And I will have a constraint. What will be my constraint? The sum of the weights should be equal to 1. That's my constraint. So this is how my solver box will look like at the end of the, just before I press the solve button. I have asked Excel, just to repeat, I have asked Excel to perform random iterations of different combinations of A and B and arrive at that combination which is going to give me the lowest possible risk. So I press solve. जैसे ही मैं solve को press करूंगा, you will see that your risk is reduced. Can you see? It was 9.68% in my earlier example, in my base case. Yes or no? And now it has come down to 7.94%. So my risk has come down. And this is the lowest possible risk that this portfolio can achieve. And अगर आप ध्यान से देखोगे, it has also given me the weights. Change हो गए ना weights? 25, 75 से it's become 9.3% of your investment in A and 90.7% of your investment in B. Now, how do you know that this is right? Is there a way to check this is right? Another way? You can do a sensitivity test using data tables. उससे भी पता चल जाएगा आपको. So what I will do is I'll keep weight of A, weight of B, and portfolio risk. And I'm going to pick up these numbers from the base case. So weight of A, weight of B is 1 minus weight of A, and portfolio risk मैं यहाँ से pick up करूँगा. And I'll perform iterations from 0 to 1. So 0, 0.1, and go down till I achieve 1. तो मैं क्या कर रहा हूँ? I'm just trying to simulate different combinations of A and B. उसके बाद I am going to introduce another row between 0 and 1. What is that row? ये 0.093. Why? Because I want to see कि इस combination में सबसे कम risk आ रहा है या नहीं आ रहा है. That's my ultimate objective. So then what I am going to do now is I am going to perform, now this I need to highlight separately. This is my base case. So if I do the data table now, I go to data. If you remember, we did it last time, data table. And in my column input cell, because all my inputs are in a column, I go and link this to the weight of A, which is my only input. And press OK. What do you get? You get all possible risks. अब इसको ध्यान से देखिए और मुझे बताइए कि सबसे कम रिस्क कहां पे है. Where is the lowest possible risk? Isn't it in this combination? 0.093 and 0.907. What is the risk there? 7.94%. Does it match this number here? It does. And in this table, are you able to see any other combination? Any other combination which gives you a risk as low as this one? है कोई? You won't. Which means that this is another way to test whether this is the lowest risk yielding combination. है कि नहीं? Now, अभी हमने क्या किया? What we have done now is we have just found out we have just handled one category of investors. We have handled a category of investors which are risk averse, जिनका objective सिर्फ और सिर्फ एक है, to reduce the risk. I have still not been able to do or capture the mindset of a risk seeker or a rational investor, for which I need to do portfolio optimization. Portfolio optimization के लिए we generally use a formula, and the formula that we use is Sharpe's ratio, which is RP minus RF divided by sigma P. You can note down this formula. Now, how do you interpret this formula? RP minus RF by sigma P. So let's take two people, Shreyansh and Unnati. Let's say Shreyansh is a risk averse investor. He doesn't believe in taking risk. So he's only and only focused on risk reduction. So he's happy investing in government securities like treasury bills, which is giving him a low but a assured return. So currently the return that he is earning is called as RF. What is RF? Risk-free rate of. And because it is risk-free, his sigma or standard deviation is 0. Then Unnati, who's an investment advisor, comes and tells him, why are you not taking risk? You can earn a greater return. So Shreyansh agrees, and he now creates a portfolio of risky assets as well as risk-free assets. And now he's getting a higher return, and that higher return is called as RP, return of the portfolio. So what is the delta return he earned out of this investment? RP minus RF. This is the delta, incremental return that he got. And what is the incremental risk that he took? पहले वो zero risk पे था, अब वो sigma p है, which is the standard deviation of the portfolio. So incremental return divided by incremental risk, RP minus RF, the whole thing divided by sigma p is your risk reward ratio, which is also called as the Sharpe's ratio. समझ में आई बात? And portfolio optimization में हमें यही करना है. We have to maximize the reward per unit of risk. In other words, in my portfolio optimization case, I will maximize what is called as the Sharpe's ratio. समझ में आया? So first I'll capture the Sharpe's ratio here in my base case. Now I'm assuming that the risk-free rate of return is 3%. I think that's what was given in the question. So Sharpe's ratio becomes RP, which is 4.68, minus 3%, which is your risk-free rate, divided by sigma p, which is 9.68, and I get a Sharpe's ratio of 0.173. ठीक है? Now अब हमें क्या करना है? हमें इसको maximize करना है. So I'm going to create another case which is called as portfolio optimization. In portfolio optimization, again, what I will do is I'll just capture my returns and risks from here, and also my correlation. That's all I need to do because everything else will be calculated automatically. ठीक है? अभी मेरा Sharpe's ratio कहाँ पे खड़ा है? देखो ध्यान से 0.173 पे. Now I'll go to data. Solver again. Before using solver, please remember, whenever you are using the solver again on the same worksheet, or you're trying to repeat the exercise, always reset. Otherwise पुराने values अगर उसमें रहे तो आपको गलत results भी आ सकते हैं. So always reset and then use the solver. So मेरा objective अब क्या है? For a rational investor, my objective will be to maximize Sharpe's ratio. So I set my objective to be Sharpe's ratio and I set it to max. By changing what? By changing my weights. Subject to the constraint that the sum of the weights should be equal to 1. And I press OK. And इसके बाद मुझे सिर्फ एक ही चीज करनी है, solve. जैसे ही मैं solve करूंगा आप देखोगे my Sharpe's ratio is now maximized to, it was earlier 0.17 and now it is 0.18. And आप देखोगे एक और चीज कि आपकी जो weights है, they are not the same as what was being suggested earlier. For risk minimization, the model asked you to put 9.3% of your money in A and 90.7% of your money in B. But for portfolio optimization, it is asking you to put 19.8% of your money in A and 80.2% of your money in A. तो weights भी अलग है क्योंकि objectives अलग है. पहले केस में हमारा ऑब्जेक्टिव रिस्क मिनिमाइजेशन था, अभी हमारा ऑब्जेक्टिव पोर्टफोलियो ऑप्टिमाइजेशन. So when your objectives are different, obviously your portfolio will be balanced or rebalanced differently. So this is how you can actually use Excel to not only model different aspirations, like a risk aspirations of a risk averse investor versus the aspirations of a risk seeker or a rational investor by using solver or data table to capture or validate minimum risk or portfolio optimization. यहाँ पे भी हम एक और चीज कर सकते हैं. We can capture weight of A, weight of B, and SR. SR stands for sharpness ratio. So I capture my weight of A again from here, which is my input. Weight of B is 1 minus weight of A. And I also capture my base case sharpness ratio, which is 0.173. And now 0 से लेकर के 1 तक, again I will introduce all my weights. Just simulate them so that I just want to make sure कि यहीं पे सबसे ज़्यादा sharpness ratio है. So between 0.1 and 0.2, I will create another row. What row will that be? For 0.198. Okay? And then now we are ready. So now we'll see कि यहाँ पे सबसे ज़्यादा ये किस पे आ रहा है, sharpness ratio. So ये मेरा base case है. So इसको मैं separately highlight करूँगा. And now data. What if analysis, data table, all my inputs are in a column, and I go and put my linkage to the only independent input and press OK. अभी देखो, where are you getting the highest sharpness ratio? Are you getting it in this place? 0.198 and 0.802. Isn't that what was given by solver also? 0.198 and 0.802, and that is giving you the highest sharpness ratio of 0.17559. So हमने यहाँ पे भी सॉल्वर और डेटा टेबल से हमने दोनों पर्सपेक्टिव्स को कैप्चर कर लिया, that of a risk averse investor and that of a rational investor. And that's how you can use financial modeling in business, and you can use this in investment management, investment advisory, risk advisory, wealth management. All your CFA practitioners who are fund house managers who deal with clients, private clients, institutional clients, they can all use Excel in a very, very unimaginable way. And there's no better example for financial modeling or for risk management than this, to be able to understand how important or critical this subject is in terms of industry application. Okay? Very good. Thank you. I'm just going to stop the recording and I'll share it with you.